Topic that I have chosen is AS2, which is valuation of inventory. Let's start with the topic. So, let us understand what is the meaning of inventory, what is its nature, what is all being included, and what are the exclusions, how do we measure all these things, right? Yes. So, in the first case, inventory is something which is being sold in the ordinary course of business. When I say this, say for example, I am having a mobile shop, agriculture minerals, oils, ores, right? Why all of them have not been valued here? Because they have their own established practices wherein they fix the price. For example, for agriculture produce wheat, right? For wheat there is an established market wherein they'll fix the price, and that is what the farmer is selling it for, right? They have established practices to determine the price or to value the inventory, and that is the reason why that has been excluded from AS2. Understood? So these are bit of exclusions from AS2. Now, so let's get into the important step here, that is measurement. So how are we going to measure the inventory, right? So again we bifurcate this into two steps. One, how am I valuing the raw materials, and finished goods and work in progress, right? So finished goods and work in progress will go in line, so which would be valued at cost or NRV, whichever is lower. Now, what is cost and what is NRV, right? So simple. Cost, when I say cost, it includes three things again. One, my cost of purchases, that is whatever the cost that I have incurred to bring that material, that is my cost. And cost of conversion, so cost of converting my raw material into finished goods. So I'll incur various costs in between, right? I'll be having a direct labor or direct material cost, and other variable cost, and other fixed cost, other variable overheads and other fixed overheads. So I have to allocate all these expenses to my finished goods, right? So all this basically my variable overhead and my variable overhead and direct labor and direct material would be allocated on actual basis, that is based on actual number of units. Whereas in case of fixed overheads, again there is a steps which is supposed to be followed in allocating the fixed overheads, right? So usually the factories would have been set the normal capacity or the average capacity that a machine could produce give in a given particular time or in its capacity, right? That is nothing but normal capacity. So that number would be determined, and it would not be same as actual. It could rise, or it could be the same, or it could be lower than the normal capacity, right? So in this case, how are we going to allocate the cost to the inventory or to my finished goods, right? So if it, say for example, I'm having a fixed overheads of 18 lakh rupees. So if 18 lakh rupees and my normal capacity or the number of units that I can produce is 1 lakh, so in this case, what is my per unit fixed overhead? It is 18 rupees. Correct with me? Yes. So everything went well, and my actual production is same as my normal capacity. Then no headache. So you will allocate 18 rupees per unit. Done? Done. Simple. Okay, good. Now you were able to produce only 90,000 units. Maybe the demand is only for 90,000, or maybe whatever might be the reason, but you produced only 90,000 units. In this case, if I divide 18 lakh of my fixed overhead by 90,000 units, then my fixed overhead per unit would be 20 rupees, right? Which means you're including your abnormal loss in your inventory, right? Which is and you're not showing the loss in your P&L. For instead you're showing the amount that is loss of 1.8 lakhs in your closing inventory, which is not correct from the accounting perspective. So what do? We will take it on an actual basis and take the remaining 1.8 lakhs loss to the profit and loss account separately, right? That should be the correct treatment. Okay, understood. Now what if I produce more? The demand increased and I increased the potential of machinery, all these things, and I worked on efficiency well. Now my number of units has been increased from normal capacity to 1.2 lakhs. Now I'm happy because the per unit fixed overhead has come down to 15 rupees instead of 18 rupees, right? So in this case, so if I allocate 18 rupees into 1.2 lakhs, that is as per normal capacity, does it seems good? No, because if you do 18 lakh into 1.2, that comes to 21.6 lakh as your total fixed overhead, which is not the actual amount, which means you are inflating the fixed overhead, which cannot change due to increase in the number of units, right? So what do in case if the actual production is more than the expected? Then we will allocate the fixed overhead basis the actual number of unit and not the normal capacity, right? As it leads to overstatement of the stock. Understood? So this is about the conversion cost. Where were we? We were measuring the finished goods, under which we were considering what is my cost or NRV, whichever is lower, under which we had cost of purchase and cost of conversion. So we understood what is our cost of conversion, correct? So once we understood the cost of conversion, it also includes some other cost. Say you have purchased your products at Bangalore and you have to bring that product to maybe Davangere or somewhere, some other places. So you have incurred the freight charges, right? Even that freight charge is going to be included in your cost of inventory. So ideally the criteria is that the all those costs which have been incurred to bring the inventory to the present and sellable condition, all those costs. So this is very important line. Okay, so to bring the inventory into sellable condition is something, all those costs will be included in calculating the total cost of the inventory, right? Okay, understood. So this is your cost. Okay, ma'am. So then what happens? My inventory is now ready to sell, but I cannot sell it immediately. Maybe because I still have to get the order from customers, or it is my warehouse now. It is in my warehouse. Now, ma'am, shall we include the storage cost for this? The answer is no. We cannot include the storage cost here because the goods are already in the sellable condition. It's just that it has been postponed due to other factors which does not impact the valuation of the inventory, right? In this case I'm not including the storage cost in my inventory. It also, in generally, we will also not consider my selling and administration cost or selling and distribution cost or administration expenses. All these expense will not be considered as these are not directly related to my inventory, right? So these are excluded from the valuation of inventories. Understood? So my cost is now clear. Next, what was the other thing? My net realizable value. As the name says, it is your net realizable value. So you will be having something called realizable value. You have to deduct something. That is when you will arrive at the net realizable value. Correct? Yes. So my realizable value is, so now I have this pen in my hand. I directly go to the market wherein I have all the knowledgeable buyers and the transaction happens between a knowledgeable buyer and the knowledgeable seller. Now that I can sell it at 10 rupees. This is my realizable value. Okay, but it so happens that I cannot sell directly to the seller. I Because I don't have any network with the sellers. Okay, sorry, I don't have any network with the buyers, like the one who can buy this. So I'll find some brokers, okay, and I ask them to find the buyers who can buy this product, and I have to pay him something as a commission, right? Because he found out the right buyers there. So for him I have to pay the commission, so which is my selling expense, right? So I have to deduct that in order to arrive at my net realizable value. So in this case it might be 10 rupees, and I have to give 1 rupees commission as to my broker, and then I'll be selling it at 10 rupees, but I have to deduct this 1 rupee to arrive at 9 rupees. That is my net realizable value. Understood? Yes. So this is in case of finished goods. So in case of work in progress, how are we going to calculate? Let's take a practical example, okay? The cost of partly finished good or inventory is 150 rupees. This is my cost. Now I want to determine my net realizable value. So how am I going to arrive at it? The selling price of finished goods of the same product is 250. So in order to bring the WIP to finished goods stage, I have to incur further cost of rupees 100, right? That is why I am deducting 100 rupees from my selling price, that is 250. So 250 minus 100, you have arrived at 150. Now the cost is also 150, but in addition to this you also have to incur the commission expense of rupees 10. So your net realizable value is 140 rupees. So at what value you are valuing it? You'll be valuing it at cost, which is 150, or net realizable value, which is 140, whichever is lower. So we will be valuing it at rupees 140. Okay, this is about the valuation of finished goods or WIP. Now let's get into raw materials. So what about raw materials? So the funda is simple here. If you are selling, it is dependent on your finished goods, okay? If you can sell your finished goods at its cost or above the cost, then you will value your raw material at cost, okay? Otherwise, if you were not able to sell your finished goods at cost or above the cost, that is you are selling it at below the cost, okay, say the cost itself is 40 rupees, but you are able to sell it at in the open market only at 40 rupees. In this case you will have to value your raw materials at replacement cost, because you cannot use your raw material directly, or you cannot sell your raw material directly which is being used in the process of production to make it the finished goods, right? That is why we will value it at replacement cost. Say the cost of the raw material was 10 rupees, okay, now I'm selling my finished goods at below the cost. Now I cannot value my raw material at 10 rupees. The same raw material can be replaced at 8 rupees, so now I have to value my raw material at 8 rupees and not the 10 rupees. But if you can sell your finished goods at 50 rupees, as I said in the previous example, then you can value your raw material at 10 rupees and not at the 8 rupees. It is simple, okay? So it depends on finished goods. So when you are at profit or at the break even, then you can book the raw material at the cost, otherwise at replacement cost. Simple, okay? This is about raw material. Now we have one more concept, which is joint products and byproduct. So what is this joint product and byproduct? So joint product is something where you have intentionally produced two or more number of products from the similar process or the same process. That is your joint product. So you have intentionally produced it. Say from the crude oil you will get diesel, petrol or kerosene, right? All this has the significant value and all are joint products of your crude oil, okay? So this was intentional. So in this case you will value your inventory in two types. Either you can value it at sale value at separation, right? At separation point you can value what is the sale value at separation. If you can determine, then you can go with that. Okay, if it is not available, like you cannot sell it until you add on some other process to those joint products, like you need to include some more steps in order to bring it to the sellable condition. That is the only stage where you can determine the sale value. In that case you will allocate this joint cost basis sale value at completion stage. Okay, that we can see it with a practical example also. This is about joint product. And byproduct is something which is not intentional, but in the process it came out, right? So when you're from the sugar cane, when you're producing the sugar, you'll get the molasses also. That is your byproduct, that is not the main product, and you are not intended to produce it, right? That is when we call it as, and the value is also insignificant. Okay, in this case we will call it as byproduct. So this is simple. What do? You will take the full sale value of your main product and deduct the NRV of your byproduct. So you can sell it off, or you may type the NRV of that byproduct and deduct that in order to arrive at the byproduct, sorry, in order to arrive at the main product cost. Okay, so this is about joint products and the byproducts, and there are various cost formulas, right? So in addition to this you also have something called as a specific identification method and FIFO method, standard method, and the retail method. When the products are not interchangeable, then you will use specific identification method. Now you have the paintings on your board, so each painting is different, right? So in this case you will have to value that painting at the same price. You cannot interchange these paintings, so you will have to specifically price it and have the same price, right? You cannot interchange. That is nothing but specific identification method. Whereas in case if the inventory is interchangeable, you can use either FIFO method or standard cost method or retail method. Okay, wherein say you have a, a one lot of calculators and you will get one more lot. In this case you can interchange them and measure it at FIFO, which is first in first out, or weighted average cost method, right? Which we will be doing. Understood? These are the cost formulas. By this we have broadly covered the concepts of inventory. Thank you.